Figure out what else lies ahead. Rakshit Ranjan of Marcellus Investment Managers joins us on the show right now with his take on the markets. Rakshit, hi, afternoon. Good to have you on ET Now today. Rakshit, your take on the market right now. Protect capital, book some profits, at least when it comes to mid and small caps, or do you think this is just a one-off aberration that we are seeing?
Good afternoon. First of all, thanks for having me on your show. Now, the answer to your question, I think, is also it needs to be contextualized in terms of the exposure that you already have. If you've got exposure in areas where there has been a massive re-rating upwards of multiples, or the earnings had a tailwind to itself over the last 1 to 2 years, which perhaps is a tailwind from the external environment. So you were in a commodity upcycle as a commodity producer, or you were let's say a highly leveraged maybe a bank with external environment becoming more and more benign in terms of NPAs, etc. If those are the exposures of the investor, then I think it's better to book profits, certainly. But if your exposure has been to sectors where fundamentals have actually run significantly ahead of share prices, so for instance, you were talking about the kind of stocks that are doing well on a day like today, you would actually invest more and more there, because there are segments of the stock market which in the last couple of years haven't progressed in share prices with the fundamentals. Those are massive opportunities to make money. So I won't say the market is overvalued as a pack. There are segments that you should not have exposure to, in my view, and there are certainly segments that deserve more and more exposure at this stage, given what has happened in the last 2 years.
So, can you be slightly more specific here? I mean, is there a list you can share with us, what to avoid and what to buy, where to reduce, where to add?
Sure. So, for instance, talking about the lenders, I think private sector banks versus public sector. Right, that's a massive, I would say, difference between how in the last 2 years an HDFC Bank or Kotak, and by the way, as a disclaimer, these two banks are part of our portfolios, our clients' portfolios, our families' portfolios. So an HDFC Bank or a Kotak or a Bajaj Finance compared to some of the other banks which have had a great rally in the last couple of years, but not for reasons that can be sustained for the next 5 to 10 years. Talk about, say, some of the consumer discretionary companies, some of the retail plays where there was a lot of noise in the last couple of years because of either COVID-related impact or input cost rising, and hence last 12, 18 months, margins were depressed, but those are not sustainable factors. Margins will recover or have already recovered, etc. So, I mean, so for instance, the likes of say in our portfolio, Page Industries, Asian Paints, an HDFC Bank, a Bajaj Finance, etc. Those are some of the stocks we have exposures to.
The raging debate in the market is whether the mid-caps are expensive or not. Yesterday, of course, we had, Sanjeev Prasad Kotak Institutional Equities dropping their mid-cap recommendations, saying they're running out of options. What are you doing with your little champ portfolio? Are you also running out of options, or which are the spaces where you are adding there? Because I remember that chemicals, financials, industrials, these were your overweight sectors there.
Yes, so we are making changes because when you're in the small and mid cap, then I guess the frequency with which you need to sort of change with the changing dynamics of the companies and the businesses, the industries in which they operate is also a little higher frequency. So yes, for instance, in some of our companies, we have some of our smaller mid cap portfolios. More recently, we have added Trent as a stock, the West Side Zudio retailer. We have added one hospital retail, hospital chain to our portfolio. So those are some of the additions, for instance, and we have trimmed or exited from some of those sectors that you just mentioned that we had significantly higher exposure to previously. But yeah, those are some of the pockets as examples.
Understand trend. I mean, I was looking at numbers. It's at what, 120 times 1 year forward. History tells us that when you buy stocks above 50, 60 times, you don't make money. This is 120 times.
Right. So that's very interesting. Two ways to understand that. One is, if you remember, 2 years ago, approximately 2 years ago, Titan was at 2,000 rupees a share when it was 250 times trailing, and maybe about 100, 150 times 1 year forward. Since then, it is up 50%, and PE multiple has actually derated, right? Because the earnings was not a normalized earning. So when you look at a business like Trent, first and foremost, Ind AS, the accounting standard 116, has ensured that if a retailer expands store count aggressively, then rental bookings, which are more linear on a cash outflow basis, on the P&L, they need to be recognized upfronted. So your costs are high as a non-cash item under Ind AS 116 if a retailer expands store count and takes on more leases at an accelerated pace. Where just for that, suddenly you realize that there's a good 30 to 40% drop in the PE multiple suddenly when you normalize for cash element or go pre-Ind AS and normalize it for that aberration. It's an aberration. It's an accounting aberration. Secondly, the next big thing is this is a retailer which is growing profits, revenues at a rate of 35, 40, 45%, depending on which business model of this retailer you're talking about and whether revenue or profit, etc. It's a high rate of growth. So the rate at which this PE multiple falls from 1 year trailing to 1 year forward to 2 year forward is a very rapid rate. And as a result, a DCF captures the true value which a PE multiple doesn't for such a business where near-term growth rate is far more accelerated variant of a normal business of this size. And there's also one other piece worth bearing in mind. There's an optionality here on Star Bazaar, the retail format, which till last year had been experimenting, and by means of doing those experiments, there were some losses. If you believe that those losses will be reducing significantly because the experiments are approaching a steady state proof of the concept, successful retail format, which we do, which that's what we believe, then suddenly the normalized earnings, it goes up. So what you're talking about as a PE multiple is on the face of it. But the moment you normalize it for how the P&L is going to look like, adjusted for aberrations, you realize that the real PE multiple is actually much lower than that.
Okay, point taken. You were also talking about some of the hospital chain companies that you've added. What's the name there, and what's the view on IT? Are you incrementally getting positive there, adding on to your positions?
IT, yes. So, for instance, TCS is in our portfolio of large cap consistent compounders, and then we have LTTS, Tata Elxsi in some of our other portfolios. And again, disclaimer: clients, families, and ourselves, we have exposure to these stocks. So these are some of the names on which we have increased our positions over the last 12 months incrementally, because the concern of the market was US going through recession and hence let's exit IT, etc. That gave us some opportunity, some pockets to increase exposures in some of these areas, which we've done wherever we see the resilience being there to the businesses. The hospital chain, actually, I'll have to check if we've disclosed the name or not yet. But it's a sort of mid-sized South India-based hospital retailer, and these are businesses which are coming of age in the sense that the demand side, which is, let's say, the patients walking into a hospital to get treated, is moving from mom and pop setups or unorganized setups to more formal, experience, service-oriented setups, which at times even end up creating a brand recall, etc., etc. But more than that, you get services that mom and pop standalone labs don't, standalone setups of smaller hospitals or clinics or nursing homes don't provide. And hence, provided a hospital chain can actually generate high ROCEs, run the business efficiently, scale it up as a large format retailer, it's a very attractive investment opportunity area.
Actually, on that note, we let you go. Appreciate you making time and speaking with DT now today. But